Okay, good morning, everyone, and welcome back to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. As always, I hope everyone is staying safe, staying home, and let's go ahead and take a look at the markets here today. A lot to look at here today, but I want to first start off by just quickly saying that what we are going to discuss here is purely for demonstration purposes. It is not a recommendation or solicitation to buy or sell any specific securities. And we're going to start off by, again, trying to help everyone answer the question that's on every single person's mind, which is, where do we head next? Is this, have we bottomed? Are we heading higher? Or is this just a bear market rally that's going to continue moving lower? So for those of you that are joining us for the first time on our market outlook sessions, just a quick recap. We've had a very nice, or I shouldn't say nice, a very violent 35% decline in the markets, a subsequent 20% rally. That rally has stalled at this point at that 20-day moving average around that 261 level on the daily chart. If we look at the hourly chart here, after initial rally push up to that 262 level on Thursday, it bounced higher, pushed back up to that 262 level yesterday. We're about to open up a couple of points lower here, not too much. I certainly think that it's possible for the markets to continue moving higher, but 262 is the resistance level that we currently have on the hourly chart. If we do get back above it, I do think that we will clear 272 and get back up to that level, which is a major resistance level. I think that if we do break above 262, we're going to have a tough time cracking 272, 273, because that is the level that, if you go back to the 2018 December lows, after rallying off those lows, it bounced off that 273 level multiple times. So we have a lot of investors that are long the markets above 273 that, any opportunity to get back to break even, they're likely going to sell. So I think that you're going to see waves of selling above 273. And one thing that I do want to point out is, as the market has rallied over the last few days off that low, we've really seen momentum continue to kind of decline here. So this leads me, at least in the short run, to believe that we might get a pullback here. Maybe not a lot, but maybe a pullback before we retest that 273 level. But at this point, between 235 and 273, my expectation is that we might get more of a range-bound market here between 235 and 273. And what we want to do is we want to look at, this is from a technical view, right? Now we want to look at some more fundamental and some of the economic data to get a sense for, if that lines up with our technical views. So recap again, for those of you that have not joined us or maybe joining us for the first time, we've had unprecedented stimulus package that was passed last week to offset some of the economic impact that we're expecting to see over the next few months. $2 trillion, significantly greater than what we saw during the financial crisis. And the difference here was timing. We launched these stimulus packages before we anticipated the actual, we launched the stimulus package before the actual recession is actually hit. And the recession will hit. There's no doubt about that. As you can see, unemployment claims jumped to about $3.3 million. The single largest unemployment claim we've ever had in history. This chart that I see that on the right-hand side goes back to 1970. As you can see, during the financial crisis, during the 87 crash, during the dot-com boom, we never exceeded 700,000 claims of unemployment. Here we had 3.3 million in a single week. So this is a very different beast than previous recessions that we've had. So we've had to launch a very different stimulus plan for it. Hopefully this goes to offset most of it. And we're already talking that this is there's already talks of increasing this to roughly another trillion, to about $3 trillion, because of the economic impact that we're likely going to see. The initial $2 trillion is to offset what we see initially, but the long-lasting effects this is going to have our economy is likely going to require more further fiscal stimulus here in this particular in our economy. So what we want to do is understand, first of all, that what caused the initial sell-off was really just uncertainty. Two things: uncertainty and a lack of liquidity. And the stimulus package and some of the data that I'll show you in the next slide really removes a lot of that uncertainty. And that helps us answer the question, are we going to get another sell-off, right? And I think that based on what we currently have, the data that we currently have, I would say that that's less and less likely each day that we go on, because liquidity is continuing improving on a daily level, and I'll show you some of the data for that. And a lot of the uncertainty around the trends for the coronavirus, how governments are going to respond. We've had global central banks ease and create fiscal stimulus packages to offset the declines in economic slowdowns. All of that uncertainty is gone. So we have a lot of certainty now as far as how governments are going to respond and how the coronavirus spreads. So due to that, and couple that with the fact that liquidity is improving, that leads me to believe that we are unlikely going to see another wave of panic selling that we've seen over the past few weeks. So the only unknown factor that we have left is the length of the economic impact this is going to have on our global economy. And that data, in terms of length, is not going to come out of nowhere and surprise us and cause another wave of panic. That type of data, which is usually weekly or monthly economic data and corporate earnings data, that stuff is going to trickle in over the next few months. So I expect that if you do have some bad news that comes in, they come in bits and pieces, it's not going to cause the same type of panic sell-off. So that is, I think, the good news for a lot of users that are concerned, if I buy stocks here, are we going to see another 20, 30% decline in the markets? I'm not saying that that's not going to happen. I'm saying that having a panic sell-off of another 30% in the next few weeks or in a short amount of time, I think at this point is fairly unlikely. And if we look at the data out of Italy, again, we've been tracking the Italian coronavirus data for quite a few weeks. For those of you that have joined us for the last few weeks, the data over the last few days have been quite encouraging, because we had total lockdown in Italy on March 9th, and we've seen the peak in terms of total new deaths about 17 days later, 18 days later. So we can use some of that similar data to project out here in terms of what we can expect here in the US, in terms of when we might see that peak, roughly mid-April or slightly before mid-April. I will say that is very different across the country, because different states and different cities have deployed different levels of lockdown. But almost 50% of the cases here in the US are in New York City, where I live, and we have instituted a fairly substantial lockdown here in New York City. But we're still seeing pockets of places pop up like Detroit and New Orleans, where they haven't instituted the same type of lockdowns. So there is still risk that in the US we're going to have more of a longer tail, if you will, than in Italy, where obviously it is a smaller country. They did do a total lockdown on March 9th for the whole country. The global response predominantly has been relatively similar. I would say a good portion of the world's population are currently in lockdown, which is good, because it gives us a timeline as far as when we can expect the number of new cases to decline. So that is certainly encouraging for us, because again, this is another uncertainty that's removed, because the markets can handle bad news. The markets are not very good at handling uncertainty. And that's really what drove that panic selling. So when we have bad news, we can deal with it. And this is certainly bad news when more and more people die. But as long as we know roughly how many people might die and when that tide will turn, this is, generally speaking, news that the markets can handle. So when we look at economic data, this is really some of the newer data that we're looking at. This is some of the data that we've been trying to answer over the last few weeks. consumer spending is by far the largest driver of the US economy. 70% of our economy is consumer spending, and we've had the single largest decline in consumer spending in history, which should not be a surprise to anyone. But now we have some new data that gives us an understanding as to where that consumer spending has declined and where it hasn't declined as much as we might think. So first and foremost, I think, and this is Bank of America credit card data. What's really great about this data set is that it's published every single day. So we get a very high frequency, real-time view into how consumers are spending and their habits. So on the top of the list, I don't think it's a surprise to anyone that travel, entertainment, and restaurant sectors are the ones where we've seen the largest decline, travel being the most, and restaurants and entertainment being the second worst industry. And this represents, if you're investing, for the future and you're looking at for stocks that you might want to buy, generally speaking, I think these are sectors that you should stay away from. If you look at clothing, furniture, and department stores, also same thing, roughly about a 50%, a little over 50% decline in consumer spending. So this is really another sector that if you're thinking about adding to your portfolio, think twice about it. Because the data coming out of it is a little worse than we had actually expected. We were looking at about a 30-40% decline, but it looks like that number is closer to 60 to 70% decline in consumer spending on that front. What does seem to stand out, let's just talk about groceries for one real quick. Groceries and general merchandise, I think this also should not be a surprise that we didn't see as big of a decline in those particular sectors, right? Consumer staples, people still need to buy toothpaste, people still need to buy toilet paper, people still need to buy food. So we haven't seen large declines in that particular space. What is interesting is that online electronics have gone up substantially. I would say most of this is probably due to the fact that people working from home now find themselves that they need to buy phones and webcams and whatever it is that they need to be able to set up their work from home. So we've seen this bump in online electronics. That is an interesting sector to keep an eye out on. And what's, what may be a little counterintuitive are home improvement and retail actually not taking such a large hit here. So home improvement only down, basically flat. We haven't really seen a decline in home improvement, which is an interesting trend. Maybe people that are staying at home are trying to figure out ways to fix up their home while they're at home. So those are some of the sectors that you may want to pay attention to. But overall, card spending down roughly 30% over the last couple of weeks. So this is a very, very loose correlation, and this is by no means a deep analysis. But if you look at the markets, we've pulled back roughly about 35% to the lows. We've obviously reclaimed a bit of it. Consumer spending's down roughly 30% or so. Those two numbers line up to, they're not too far apart, which leads me to believe that, where the markets currently are somewhat fairly priced, right? Meaning I don't expect that we're going to see this huge rally here, because this is how much consumers have pulled back in spending. And I don't really see a significant further decline unless consumer spending continues to erode to a much significantly lower. So, what's interesting about this data is that now this gives us the data that we sort of need to start thinking about how do we position ourselves going forward. So I want to take a look at some sectors and markets that we want to focus on. First and foremost, electronics and semiconductors are sectors that I think are going to be fairly strong, as we shift our way to working from home and then go back to working hopefully in the next couple of months. So what you really want to focus on more are these stocks that have strong balance sheets and cash. These obviously Apple and AMD are two stocks that stand out in this particular space. They are by no means the only stocks that are in this particular space. They Apple, if we look at the estimates from Bank of America Research, they're currently estimating about a 15% decline in iPhone sales, which projects out to the other products as well. We do see some of that offset by the streaming services that people have bought as a result of staying home. AMD provides chips for a lot of the consumer electronics that we're seeing the strength in over the last few weeks, and speaks to the strength that we're currently seeing in some of these stocks. And I'll pull up OptionsPlay here in 1 second, but AMD is back near its December highs. So clearly this stock has not taken the same hit as some of the other stocks. So these are the types of stocks that we want to focus our attention on if you're thinking about trying to buy stocks off of a bounce, or stocks that are less affected by the coronavirus. Consumer stocks. This is where I think perhaps the rally that we've seen in these stocks may have overshot it a little, and I think that maybe you might see some of these rallies fade. If you look at some of the consumer spending in clothing, we're seeing 60-70% declines, but if you look at Nike's barely 10% off of its all-time high. Now, certainly Nike is one of the strongest stocks in this particular sector, but that also means that it's rallied the most off of those lows. And I think that based on the consumer spending data that we're currently seeing, especially if you look at the recent past few days as Nike's moved higher after the earnings announcement, the momentum has really continued to move lower. And this tells me that you have some divergence here that you're likely going to see perhaps a move to the downside as perhaps these stocks have gotten a little over optimistic on a recovery. Nike had this pretty big earnings announcement and subsequent move afterwards as a result of data out of China coming out a little better than they had expected. But I think the rest of the market still needs to catch up as far as where consumer spending is, where consumers are really spending, and clothing is really not one of those places. And you can draw other conclusions to other clothing stores or other clothing brands, but I don't think there are a lot of other clothing brands that have rallied 20-30% off of those lows as much as Nike and maybe even Lululemon has. These are stocks that I think are positioned well for the long term, but in the short term their recent strength may see some fading. Those are some of the trends that I'm currently seeing. Telecom is also an interesting one because it's a utility stock, right? Despite the coronavirus, we still need to pay our cell phone bills. We still need to stay in touch with everyone. If anything, we need to do it even more. And as consumer confidence erodes, I tend to find that the companies that are focused on better products and consumer and price focused are likely going to do better in this particular trend. So T-Mobile, the newly formed company with Sprint, which predominantly has been the more price sensitive telecom company, I think in an environment where consumers are more focused on pricing, perhaps as they have less purchasing power, are going to see higher growth in stocks like T-Mobile versus Verizon and AT&T. And if you think about the companies that are going to benefit from the 5G rollout, such as Qualcomm, those are also some of the semiconductor stocks that I'll be focused on in terms of looking for strength and looking for stocks to buy going into this type of environment that we're in. And lastly, energy and travel. This is a sector that I would stay away from because not only do I expect weakness over the next few months, the rest of this year, but going into 2021, I think is going to be an extremely challenging time to navigate for both the energy sector, which if we look at crude prices, continues to move lower. I think that you're going to see a lot of companies not make it through 2020 in the energy space. There's going to be a lot of consolidation. There's going to be mergers just to stay alive for a lot of these companies. There are very few companies in the US that are capable of getting oil out of the ground even if oil was another $10 higher, that would struggle to get oil out of the ground. So at 21 bucks, you really only have Saudi Arabia, Russia, and the major companies that are able to produce oil at this price. Pretty much, I think you're going to see wells shut down in the US. Fracking, I think, is going to get decimated as a result of this. So stay away from energy, in my opinion. And also travel. Travel is the same problem. You know, I got a lot of questions of whether, you know, it's time to buy airline stocks, time to buy cruise stocks. I don't think it is time yet. Looking at the data, if we look at this sector of the market has been absolutely decimated, and it's only getting worse. It's not getting better. So, and you know, until corporate travel gets back on its feet, and they're definitely going to be the first ones back on their feet as far as travel. I don't think consumer travel is coming back anytime soon, just because even if you wanted to travel around the world, a lot of countries aren't allowing you in their countries yet. Until those are lifted, I don't think it's time to invest in some of these travel stocks. So those are some of the sectors that I'm starting to pay attention to. And I will say, you know, as you ask yourself whether or not it's time to buy or sell a specific stock, a lot of times I think it's based on basic common sense. Think about whether a company or a sector that you're investing in is either heavily influenced or benefiting from the current economic state that we're in. And that should give you a pretty good sense for where things are. And data like this is very useful in helping you understand, well, data like this is very useful in helping you understand, you know, yes, we know travel is impacted, right? Yes, we know retail is impacted, but by how much? This is really the type of research, you know, for those of you that are looking for this type of research, you can get it for free if you have a Merrill Edge account. Bank of America, Merrill Edge provides this research for their brokerage clients. You know, I have a brokerage account at Merrill Edge. That's how I access this research. It is one of the best research that I see out there for retail brokerage. Normally, this is the type of research that you only get as an institutional investor, but they give access free of charge to all of their retail clients as well. And lastly, options liquidity. So, look, like I said in the beginning of this session, that liquidity is slowly coming back, but it's still nowhere near where we were. Right before the crash, liquidity was actually really strong. We were seeing 4, 5, on some days 600 of what we would consider very liquid optionable names that we would trade and have no problems getting filled, you know, near the midpoint or pretty much at the midpoint. That list is now a third of its normal liquidity, but it is improving every single day. You know, when I did this session a couple of weeks ago, that list was down to 55 names. Normally about 500 to 600, it was down to 55. But it's improved pretty much day by day as we've gone on. The number is now about 130 names. You can find that list at trade.optionsplay.com/liquidity. We are also adding this to our platform for those of you that want to access this service. Not only are we now providing liquidity, meaning what you're going to be able to see is the symbol and whether it's very liquid or somewhat liquid, but we also added the implied volatility rank and the next earnings date so that you can take a look at and very quickly scan for potential ideas that you might want to trade. So we're really trying to provide as much, Mark, I think you spelled liquidity wrong here on that particular, that's why you're getting the 404 error, but liquidity. So I'll just post the link to everyone. Trade.optionsplay.com/liquidity. And we will be adding this link to our platform so that you can access it directly from OptionsPlay. But very important at this point to focus your trading on these liquid names because, again, if you go outside of these names, liquidity is still not there. You're going to have a tough time potentially getting filled at the midpoint or near the midpoint. So my suggestion to you is, as you're trading this, you know, when we were speaking 2 weeks ago, I was saying you really could only trade the ETFs, because those are really the only names that were liquid. But implied correlations have come down, volatility's come down, and the liquidity list has improved. Now it makes more sense to pick individual stocks. So that is the coverage that I wanted to share with you here today, the research that I wanted to share with you. Yes, this IB rank is color-coded. The red ones are the high implied volatility. The green ones are the lower implied volatilities for those of you that want to seek high or low implied volatility. And we're really trying to add more of this type of research into your trading process. We have a new earnings calendar that's coming out. So we have a lot of cool things that are coming out to help you with your trading. But I really hope that this was useful in helping you guys better understand where we currently stand, where we're likely headed, and how to position yourself going forward. So I have a few minutes to try to answer some questions. If anyone has any questions, you can type them into the chat window. Do you have any suggestions in the healthcare sector? So I find it difficult to pick individual stocks at the moment just because it's so speculative as far as which, pharma stock might do well. I'm more inclined to trade the sector as a whole, XLV. XLV has broken out to all-time, unlike the rest of the market that has kind of stalled, XLV, the healthcare sector, has continued to show strength. The momentum has not slowed down like the rest of the market. So as far as investing in the healthcare space, I'd prefer investing in the whole space rather than these individual name. Or if you want to get a little bit more speculative, looking at the biotech sector as well. Same type of trend, rally off the lows. Momentum has not waned, it's continued to move higher, which is certainly better looking than if you look at the broader market, which has stalled quite a bit. Looks like we're opening up a little bit lower here today. Again, 262 is a major resistance level that we're looking at here in the market. Please define options liquidity. Options liquidity is simply the ability to get filled at the midpoint or close to the midpoint. That's really it. Looking at the bid-ask spreads intraday, giving us a sense for how well market makers, or how market makers perceive the liquidity. The tighter the spreads, the more willing market makers are trying to fill your orders. So we're looking at that, and any stock that falls under very liquid, we expect that you should get filled at the midpoint. Anything somewhat liquid, I would say within a few cents off of the midpoint, you should have no problem. So if you're talking about energy and you're talking about Exxon, if you're talking about the major players, those are the only guys that I think are going to survive and continue to be able to pump oil in this particular state. Any of the other smaller, fracking guys, Perma, Basin, none of those guys are going to be able to keep their wells flowing at these prices. Are you now bullish on SPY? I continue to be. I'm certainly. Let's put it this way. I'm not bearish on SPY as much as I was anymore. I do think that we're going to retest our 235 lows. I don't know when that will happen, but I do think that we're going to get a retest of that 235 low, but I don't think we're going to go below 235 based on the current data that we have. Do I think Domino's is going to go higher? I don't think so. I think Domino's went too high. It looks like Domino's is opening about 25 bucks lower here today. It's really hard to say. I guess it really depends on how long this coronavirus kind of lasts for, how long we're in lockdown. But I think Domino's went a little faster than the market could. I just think Domino's rose a little too fast, too far, and is coming back to reality at this point. I'm more bullish on Apple. Technology, I think, is a mixed bag. I think where I would focus on in terms of technology is more on strong balance sheets. If you look at some of the strong balance sheets like Apple, those are Apple, Microsoft, Amazon, Well, Amazon's not a technology stock, even though I kind of think they are. Those are the names that I would focus on. And then you have a lot of weak players that have very weak balance sheets that I would stay away from. So I don't like the whole sector, but I do like individual stocks. Would you do leaps now? Yeah, I have quite a few leaps right now on quite a few stocks, and a strategy that I've spoken about many times over the last few weeks is really calendar spreads, buying long-term leaps and selling short-term weeklies against it. It's a trade that I posted on Options Action on Friday, trying to buy some long-term hedges against some downside risks. But really, leaps are some of the places that I have positioned myself. So I hope you guys have found this useful. The market's just open. Looks like we're opening up pretty much flat on the day. So I hope everyone has a great trading day. Happy Tuesday. And I'll see you guys on Thursday, where we're going to start off a new options course. We have a great lineup here for you in April. Earnings season is about to be kicked off in a few weeks, so I'm going to be doing a special event for earnings season. We have a new earnings calendar for you guys so that you guys can have a different view into the earnings calendar with some options data to help you inform your decisions. And really looking forward to getting that started and kicking that off here in April. So again, stay safe. Hope you guys have found this useful, and I'll send out the recording to everyone in a few minutes. Have a great trading day.